Interpublic Group of Companies, Inc. is one of the largest advertising companies in the world. Since 2012, the company has morphed from a pure growth stock into a dividend growth stock. You can see that their dividend, connotated by the white line on this fast graph, has increased very nicely since they started paying one. And you can also see that their earnings growth has been good. They faltered a little bit during COVID, but they averaged over 11% a year. When you put weekly closing stock prices on the graph, you also see that stock prices track that. However, there are times when the stock was overvalued and times when the stock was undervalued. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. And we chose a company here, Interpublic Group, to talk about today for several reasons. One is that I had James Long, our research associate, prepare a research report on the company. So that we'll be adding that to the website. This is one of our, companies that we're thoroughly researching on your behalf. And so we're trying to give you a clear perspective of whether this company is a buy, sell, or hold. But there are also some lessons on valuations. One of the things that we included in our research for this particular company was we talked a lot about value investing and how it works. And I think that's real important because I've gotten a lot of comments here recently about people looking at companies like Medical Properties Trust that we did a video on a while back, and how the stock is down 30% and how, horrible that is. And, there's a lot of investors out there who suffer from what I call instant gratification syndrome. If the stock price doesn't go immediately up, then they think they're wrong. And they focus so much on stock price that they really forget that they're investing in a business. And it's the business results that ultimately are going to determine whether they make money or not. And by the way, I'm always orienting all of my videos and research to the long-term investor. I call it business perspective investing. And I do want to, talk about that a little bit in this particular video because we're investing in the business. We're not buying the stock. We're investing in the business because we think the business gives us an opportunity over time to generate operating results that can reward us either through dividend income, capital appreciation, or some combination of both. So the point is, value investing is all about long-term investing because it takes time. Companies only report financials once a quarter. They only produce their financial statements quarterly. And therefore, it takes time for them to grow. Their revenues, their businesses, their profits, their dividends, happen over time. And in the meantime, over every day, week, month, but primarily day, and sometimes you can also argue every hour, the stock price is bouncing around like a crazy ball. And sometimes it goes erratically up and sometimes it goes erratically down. And, sometimes it's justified, sometimes it's not. But by focusing on fundamentals first, that gives you the ability to at least have an attractive perspective. So I want to go through Interpublic Group here, this large advertising agency, with you from the perspective of Fast Graphs. And a lot of the information about the company we've put in the research report, and I'll be also introducing some throughout this video. But I want to focus on the price action of this company since it started paying a dividend. So let's go to the Fast Graph. They paid their first dividend in 2011. They paid 24 cents. Then they raised it to 30 cents, and then 38 cents, and then 48 cents, and 60, 72, 84. I'm just going to let you follow my mouse. Okay, I want you to note that this dividend line has been the most consistent line on this graph. The earnings line, which is actually the blue and the orange line, they're actually superimposed here, both of them representing about 15 times earnings over this period of time. And you can see how the price correlated that. Now, sometimes the price was below 15 earnings when it was undervalued, and there was a long period of time where the stock was trading above 15 times earnings. But also notice that, here was a long period of time, but there was even a lot of volatility there. Then it came back into a reasonable valuation, and then it became undervalued for a while, and then COVID hit, and we had this flash crash. Now, this was approximately a 30% drop, in value, actually 40% drop in value. That's a very strong drop, very commensurate with, some of the things people were worried about with some of the stocks we've covered here recently. And this happened very, very quickly. And that's why one of the reasons I wanted to bring this out, because I want to talk about value investing. But then subsequent to that, this turns out to be perhaps the best time you could have bought the stock. All of these undervalued situations turn out to be the best time you could have bought the stock. And all of these high valued situations turns out to be less than optimum times to buy the stock. I want to make that very clear. But if you'd have bought this stock at the very bottom, and of course you wouldn't have had any way of knowing that, and held it even till today, where I do consider the stock moderately undervalued, you'd have averaged over 40% a year annualized from April 2020 to March of 2023. That's a very short period of time, but it's long enough. It's basically a business cycle to see how you can make a lot of money. But initially, if you'd have bought the stock when it was at, before it collapsed 40% and held it to today, and this is a very important lesson, your rate of return would have still been 16%. So valuation matters, and it matters a lot. Same company over the same basic time frame, just a few months difference in measuring it here, and you can see the difference in performance. But the key is the bad performance, temporary bad performance that the stock generated is what actually ultimately creates the best long-term opportunities, as long as the fundamentals stay intact and as long as the fundamentals keep producing. And we saw in 2022, I do also want you to notice again with Interpublic Group, the company's stock price dropped over 30% in 2022 for the first 9 months of the year, basically. And that was a precipitous drop, and the company was dropping. Now, why did that happen? I think one of the things that's also important about being a value investor is not always just to be recognizing whether the price went down or the price went up, but also you want to try to come up with a thesis of why it did. Now, practically speaking, 2021 was a 50% growth year. You can see that very clearly right here at the bottom of the graph. Earnings went from $1.73 to $2.60. The stock obviously ran in sympathy with that tremendous opportunity growth. But then as we entered 2022, growth rates started to slow, and you can see the slope of the line drop precipitously. So as each quarter passed with lower growth rates than what the investors have been accustomed to, the stock price fell dramatically. Now, we also know that 2022 was a bad year for most companies. It was really a pretty bad year for the market, et cetera, and it was no different for Interpublic Group, but it did have a 30% drop. Starting in late in the year, in September, basically, of 2022, the stock rallied again, and it rallied to its peak, if you will. It rallied and increased about 41%, which would have been 160% annualized rate of return, which would be crazy. But even if you're measuring it to today's value, which it is backstrapped again a little bit, the stock was still up over 38%, averaging over 102% annualized. The point is, low valuations are the best times to buy good companies if their fundamentals remain intact. And this company raised its dividend. It raised its dividend through COVID. It currently offers a 3.49% dividend yield. It has an earnings yield of 7.81%, which is above my 6.5% kind of minimum threshold, if you will. It is an investment grade. It's one of the few investment grade advertising companies that's BBB rated. It has moderate debt at around 51-52% debt to capital, but it also has a very excellent growth rate. But we came through COVID. Now, another thing I want to do here is I want to make a point about the analytical capabilities of FastGraphs. It's a tool to think with, okay? And here I'm looking at 11% growth that was achieved during this period. If I drop this down to a 9-year period, now my growth rate has fallen to 10%, but still very, very similar and very, very close. And I get a different perspective. During this period of time, I want you to notice we had a couple of years where the stock was trading below my 15 times earnings, 6.5% earnings yield, 6.66% earnings yield, what I consider fair value. but it did that for, a relatively extended period of time and then even collapsed during COVID before it reverted to the mean and recovered again. And sometimes that time frame happened very short in a year. In this case, it went over 3 or 4 years. The point is to be able to recognize where valuation is and what's going on. Now, this was obviously a weak year for the company, so there was some justification for a weaker stock price. But I believe the stock price should have been tracking the orange line, and the market was overreacting to what appeared to be some bad news. Now, if I shorten this down to the last 8 years, I don't want to include the forecast years, we see that we get about a 13 multiple. The market has been, for the last several years, been putting primarily, most of the time, a low valuation. But then when the business did real good in 2021, it went back to that 15 PE ratio. All right. So the stock price is obviously a very erratic line. It's very volatile. And right now, if I was looking at Interpublic and I was telling you, what I think, the valuation is, I consider it fairly valued. I think it's an attractively valued, high quality growth stock with a good dividend yield and a chance to grow. But if you look at this company long term, longer than I've been showing you here, there is some cyclicality. And, the company was massively overvalued in 2004, even though it had very weak operating results. And the stock price obviously reacted to that. Now, once it started paying a dividend and became a dividend growth stock, as I've been showing you, throughout this time, then all of a sudden the stock price reacted to that and the company's dividend growth. So if I look at performance over this time frame, I do want to point out it's attractively valued at the beginning and slightly undervalued at the end here. So we got an 11% growth rate. I always want you to notice how performance correlates to operating results, adjusted for valuation anomalies. So if I look at performance here and I look at capital gain, it's 11.6%. That's consistent with the 11% growth. The company did pay dividends of over $7,812 over that since it started paying one. This is based on a $10,000 investment. It paid more income than the market did. It generated a better rate of return than the market did, even though the market is currently still overvalued and Interpublic Group is undervalued. It generated a better rate of return than the overall market, and it grew dividends at a rate of about 15% a year. But I do want to notice, as we point out, as James Long points out in our research report, the dividend growth rate has been slowing down a little bit, but it's still averaging 7 or 8% over the last 3 or 4 years. They just raised their dividend by 7% in February of this year. So we're still looking at, dividend growth, but we've got very good performance here, and that's performance that's based on good operating results and the stock price consistently, moving in and out of fair value, sometimes overvalued, sometimes undervalued, but, eventually, ultimately always reverting to the mean. That's very important. To look at this company from some other aspects here, as a dividend-paying stock, I like to see operating cash flow higher than the dividend. Again, I want to note that 2022 was a very bad year, but other than that, the company's dividend has been extremely well covered by cash flow. And even more important, the more acid test, I like to call it, for free cash flow to equity, has also generally covered the dividend except for 2022, which was, again, the troublesome year, but the company has recovered very strongly. Cash flows have recovered very, very strongly. If I look at other metrics, the company's sales growth has been per share has been about 5.5%. It's trading at a little bit of a premium valuation to its normal price to sell. So that's another consideration that I would take. I would like to switch over now to the financials a little bit and talk about things like the free cash flow. I want you to notice that the free cash flow has always been greater than the dividend, except for 2022, which, it got a little bit dicey in 2022. As I've mentioned, 2023, as I've shown you before, it's recovering. Operating cash flow growth has been good, but again, operating cash flow growth was weak in 2022, but it has recovered. Share buybacks are not really very relevant. The company has maintained a pretty level share count, certainly since, 2017 or so. I already covered sales revenue. The company generates good returns on equity. This black line here is the industry standard. You can see it's above industry standard. It also generates good returns on invested capital, double-digit rates of return on invested capital. So, I like that about the stock. I do want to point out that this company is really a very well-diversified company as well. But here's the point I want to make. If I look at this stock long-term, where it's possibly coming up or entering a recession coming up possibly, that's a lot of prognosticators are thinking that. So if I look at this stock from what the analysts are thinking, I get some encouragement here. In other words, 6 months ago for 2022, analysts, or 6 months prior to their reporting in 2022, analysts were estimating 271, then they dropped it to 270, and then just before earnings were announced, they raised it up to 274, and the company did beat by a penny and earned 275. For 2023, analysts were originally saying 277. They dropped that to 272, and then now they're at 286, which is where they sit now. And you can see the estimates have been rising on this company. The analysts have been getting more optimistic about this company as we move forward. The company has made, and we talk about this in the research report, some really strong acquisitions. The company grows organically, but it also grows by acquisition, and it has a lot of opportunities. If you look at, other research, like I looked at, research like Morningstar, and, of course, they call Interpublic one of the global big five advertising holding companies, and it is a holding company. I think that's real important to recognize that. They expect top-line growth and additional cost control efforts to expand the operating margin from a 3-year average of this is Morningstar, of 14.7 to an average of, I don't know, this might be a typo, of 146% during the next 5 years. I'm not sure that that's true. But they do also point out that significant consolidation has taken place in the advertising business. And this is not just a traditional advertiser. The company operates as a holding company, allowing the acquired agencies to maintain their own reputations. In other words, they have all these various companies, which I'll show you in a moment. And the company has gotten heavily into digital recently. So let's go to Fast Graphs here and go to the company's website. And let's look at some of the companies that IPG operates. And you can see some of these brands are very strong brands throughout the various, advertising and digital networking and advertising that exists out there. So they're an extremely well diversified company. That's good and bad news. Makes them a little harder to analyze. I encourage you to go ahead and look at that. I encourage you to read the research report that's associated with this video. But let me summarize this and kind of conclude where I'm at with Interpublic Group of Companies. I like this stock today as attractively valued based on its forecast for growth going forward. I do want to point out, though, if there is some weakness coming up in a recession or whatever, and rising interest rates, et cetera, because this company is economically sensitive to an extent, you could see the price falter. If the price faltered, I would consider that a better opportunity to invest in the stock. I don't let price action, cloud my judgment. I focus on fundamentals first, and I harp on that over and over again. And it takes time for a company to grow their business. It takes time for a company to, raise their dividends and generate the cash flows and the earnings for that to happen. Value investing is long-term investing. It's not short-term investing. And it's all about investing in the business at a price that allows you to either participate fully in the business, or even better, buy it when it's undervalued and get some natural leverage where you can get some PE expansion in addition to the growth in the dividend. Anyway, this has been Chuck Carnevale. Hope you enjoyed this video. Again, we wanted to show this video. We wanted to talk about value investing a little bit in this video because I think it's really kind of required with what's been going on in the market recently. Some of the stocks like Medical Properties Trust. By the way, my opinion on that stock has not changed. It will change if the fundamentals deteriorate. But so far, all I see is short sellers kind of putting out a lot of bad sentiment about the company. I don't know how much of it's true, if any of it's true. But so far, management seems to be steadfast. It looks like they're improving things in their tenants. So, I still like the stock very much at these valuations, just as I liked Interpublic Group, IPG, when it was inexpensive. Hope you enjoyed the video. If you did, give me a like, subscribe to the channel, subscribe to Fast Graphs if you haven't already, ring the bell, and all that good stuff. And I look forward to talking to you guys again real soon. Thanks for watching.